We've got two problems. We're all living in a post-vaccinated world, and the vaccine will not go away. That's a problem. Second, very high valuations leaving the market vulnerable to a downturn. Those two problems are colliding today. Look at the sectors, the weaknesses in the cyclicals, the stuff that did really well on hopes that the global economy would be reopening. So energy's weak, banks are weak, tech, in the middle of that, consumer staples, defensive name, doing a little bit better. This makes a little bit of sense. The downside leaders, again, they're all cyclicals. You see the cruise lines, you see the airlines, you see copper stocks like Freeport-McMoRan, you see the oil stocks like Schlumberger, all weak. Again, generally, these are characterized as cyclical names. The market internals, we've been talking about this for a couple of weeks. Traders have had a problem with the way the markets look. The momentum, the percentage of stocks above their 50-day moving average, momentum indicators have been slowing, although they're still strong. Breadth has been weaker. The advanced decline line's been a little weaker. New highs, they've been kind of crummy in the low single digits, 10, 20, 30 in the S&P 500. That's not much at all, given the fact the S&P is near a new high. The other thing, of course, we've been talking about, we did this last week, small and medium-sized stocks have been underperforming really since April or May. Look at the Russell 2000. It's 10% below its recent 52-week high. The S&P mid-cap is 8%. The Dow Transport's 12%. This is a little worse today, but this was going on for the last couple of weeks, and we've been talking about it. So it wasn't like this weakness has appeared out of nowhere. Active traders, call active traders. They'll tell you, this is a really tough market to make any money in. They've been saying this for weeks. Lowry over the weekend, oldest technical analysis service in the United States, been reading their work for decades. They said the body of evidence reflects an investing environment where it's difficult to find attractive stock to buy, whether from new money or cash raised from the pruning of weaker stocks. Again, this is a sort of intellectual way of saying, boy, it's really been hard to make money in the last few weeks. The good news is earnings, which had better be really good, have been good. You see what happened today? Look at AutoNation. Used car sales are crazy. Same store sales up 54%. That's not a typo for AutoNation. They've huge repurchase program. 15% of the stock repurchased year to date. They're doing more throughout the year, so that's going to keep going. And the CEO says demand continues to outpace supply. AutoNation, flattish right here. Tractor Supply had amazing numbers, 8% beat. Their comps were up 10%. They raised their full-year guidance from 5 to 8% up to 11 to 13%. Great numbers. Wait a minute, the stock's down 6%. David, why is the stock down? Well, these stocks are expensive. This used to be, Tractor Supply used to be, 20 times forward earnings, somewhere around there, 18 to 20. Now it's 24 to 25 forward earnings. David, that's a problem. The multiples, you cannot have high multiples or hope that multiples are going to keep going up when you're at an earnings peak. They might still be going up for earnings, but they're decelerating, and that means generally lower multiples. And when they're really high, like they're way above historic norms, like you're seeing with Tractor Supply, you've got a problem even with terrific earnings. So those multiples, David, right now, even at 20, 21 times for the S&P 500, that multiple is under some risk right now. Back to you.
Yeah. Shepard Smith here. Thanks for watching CNBC on YouTube.